View on the market, a practical view of today's financial markets. Unlock the potential of your portfolio performance by maximizing your investments. Learn how mutual funds, exchange-traded funds, and real estate investments can create diversification. View on the market starts now.
Tonight we're going to talk about REITs, what they are and why we should invest in them. And REITs stand for Real Estate Investment Trusts. And if you have a portfolio and you want some kind of steady income stream, this is one of the methods to do it. And we brought in Jim again to kind of explain why we need a REIT, or what's the advantage of having it and how do you get it. So with that, I'll turn it over to Jim.
Well, great. Thanks, Jeff. So REITs are, as you mentioned, stand for Real Estate Investment Trusts, and basically what they are traded securities that invest in commercial real estate or residential real estate that is income producing. So the idea is that if most people, if they want to make an investment in real estate and they're not thinking about investing a large sum of money, or even if they are thinking about investing a relatively large amount of money, they want to be able to, or they may want to be able to diversify and have sort of more than one property or more than one sector. So what REITs allow people to do is basically invest in a security that's inherently diversified, meaning that there are multiple properties, multiple underlying investments that are then sort of diversified across multiple investors.
So is it like a fund, like a regular fund that we can say, okay, I'm going to diversify in commercial real estate such as housing, and then apartment buildings, and then maybe strip malls and things like that. So are there different REITs kind of in different areas, and that's how you do it?
Yeah, that's a great question. I mean, it is like a fund in the sense that you have some of the attributes of mutual funds or other types of funds. You have built-in diversification, which is one of the essential reasons why people might want to look at REITs, at all. You have a professional management typically, so the person who sponsors the REIT is usually somebody that has expertise in real estate and an understanding of how to identify, source, and manage and maximize value on the investments that they make. But it's different. They're different than funds in the sense that they tend to be, first of all, they're investing in real property as opposed to securities. So a typical fund will invest in securities, and then the securities comprise the assets of that fund. In this case, the investments are actually in real property, and so it's more like a company that focuses on investment in real estate and earning income from real estate. The other kind of thing to add is that unlike other companies where there aren't any specific requirements on distributing income, REITs are by statute required to distribute 90% of the income that they produce. So compared to a typical stock or other type of investment, you pretty much know that if the REIT is making money, then you're going to get a distribution from the structure, because that's the way that they're designed to work.
So they have to pay out at least 90% of the net.
That's right.
90% of the net, and then do they pay it on a quarterly basis, or is it on a monthly basis? Does it differ?
It really depends. I mean, typically quarterly is quite common, but it really depends on the particular structure and sort of how it's designed.
And what are some REITs that you would suggest to kind of look at, or like if you would say, well, right now commercial real estate is really strong. It's a strong market. It seems to be growing in this kind of economy, and it also seems that strip malls are declining. I mean, how do you get started?
Yeah, well, the nice thing is that there's different flavors for your individual investment interests and investment kind of expectations. So there are REITs that focus on U.S. market, broadly diversified. There are REITs that focus on markets in Europe or markets in Asia or all sorts of emerging markets. And then within the U.S., there are individual securities that focus on particular sectors. So, for instance, if someone's interested, let's say, in public storage facilities and facilities that invest in firms that do sort of mini storage and that kind of thing, there are REITs that focus exclusively on that. Or if you're interested in apartment buildings or residential real estate, there are REITs that have a kind of a more kind of a specific focus on that type of investment. So there's really kind of a broad range of options available, and you can get as narrow or as broad as you like.
So is it time specific in terms of like a 3-year REIT or a 2-year REIT? Can you get in and out like you can like a stock?
So the answer to the first question is they're not really time specific. They are structured more like equity securities where they kind of operate as a going concern. But there is a high degree of liquidity, at least in publicly traded REITs, which is really what I would recommend for most investors who are interested in the space, because they trade on a stock exchange, usually the New York Stock Exchange or American Stock Exchange, one of the main stock exchanges. And you can really trade them or invest in them just like you would a stock. Similarly, because you have because they do trade like stocks, there are mutual funds and ETFs that invest in portfolios of REITs as well. So if you have a small amount of money and you want to get diversification even across a number of different REITs, then you can do that by investing in a mutual fund or investing in an exchange traded fund, an ETF that in turn invests in REITs.
So there are specific funds that are targeted just as a REIT, and that further diversifies that, and they do all the research on the basic viability of the asset, right?
That's right.
What are some of those companies that do that?
Really, most of the mutual fund companies that most of your watchers would be familiar with. So Vanguard is a very popular one. Most people know Vanguard Funds. It's one of the largest retail mutual fund companies in the world. They have a U.S. REIT fund and REIT ETFs. They also have an international fund. Dimensional Funds has REIT products, Fidelity. So most of the large mutual fund companies, the ones that have multiple funds have REIT mutual funds. And then there are a number of the ETF providers, ETF sponsors, who also have real estate investment trust offerings as well. So iShares, which is one of the larger ETF sponsors, also has sponsors REITs as well, U.S. and international.
I just muted myself. Oh my God! I have my own quality control button. So that would be the easy way to kind of get involved in it. And although it's not going to pay out, there's another management fee that goes above that. But now, would they pay out on a monthly basis or a quarterly basis, like a Vanguard fund that's in REITs?
Well, they're going to receive the distribution of the underlying REITs that they invest in. So depending on sort of the strategy of the fund, they may collect dividends from the underlying REITs. They may be trading in and out of certain securities and rotating sectors depending on where they see the opportunity is, and so that'll affect in turn the way that the funds distribute their income and their capital gains distributions.
All right, I'm going to ask one more question, and then I'm going to see if anyone else has a question, because I don't want to dominate this thing, but I have one. So if you had a portfolio, which we have portfolios, right? Would you say 20% should be in REITs, or is that a good balancing? Because if you don't want to invest in real estate and buy a house and buy a rental property or something like that, and you have some money, what do you think the percent of your portfolio should be in REITs?
Yeah, that's a great question. I mean, it's really hard to say, and I'm going to kind of give a non-answer answer. It really depends on sort of what your particular portfolio looks like, not only your investment portfolio, but also as you say, whether or not you own a house, whether or not you have equity in your house, whether or not you have rental properties, and then also what your investment objectives are. I mean, if you're looking at sort of long-term investing and can afford to take some risk in your portfolio, then real estate operates as a nice diversifier for both equities and fixed income. If you're focused more on kind of maintaining the stability of your portfolio and really on short-term needs, then it probably would be a pretty poor investment because you wouldn't be able to take the risk. So the best way to look at it is within a diversified portfolio, it makes sense to have some allocation. Probably closer to 10 than to 20. But it really depends on sort of, again, what that underlying kind of risk profile looks like, for you individually.
Okay. So, Duke, do you have a question about the economy and REITs?
Well, I was just kind of curious as to how REITs do in today's economy, down economies.
Yeah, that's a great question. I mean, there's kind of two components to. I mean, first of all, you keep in mind that the underlying assets and REITs are ultimately what's going to drive the value. So if if real estate markets are buoyant and strong, then chances are the REITs are going to be strong as well. And if the underlying assets get beat up through liquidations and through kind of a drop off in the real estate market, then that's going to affect REIT valuations as well. So ultimately, the market tends to be reasonably efficient in repricing REITs, and in fact that was realized during sort of 2007, 2008, 2009 when the market got beat up pretty handily, along with with all asset classes, all risk asset classes. Now you've kind of got a situation where if we haven't hit the bottom, then we're certainly pretty near the bottom. And the market has tended to recover somewhat, and I would say even more so because of the fact that with interest rates coming down, it's made any sort of income-producing asset class look relatively attractive. So in fact, REITs are one of the best performing asset classes this year. I think number 2 or number 3 on the list of asset classes that we track, over 15% year to date. So quite strong performance this year.
15%.
15.
1.5.
Yeah.
That's pretty good, actually. That's really good.
Yeah, you just answered my question. I was actually going to ask something to the effect of how do they, besides how do they perform in a down economy, I mean, how do they continuously perform? I mean, do they outperform standard stocks? Do they, how like some stocks will go up and down, where will REITs more or less, are they more of a stable entity in the stock market? In essence, even in a down economy, I mean, they seem to stay up, but you kind of just answered that. So.
Well, yeah, they're different is I guess the best answer. They sometimes will perform better, and sometimes in line with stocks. I would say that where they tend to perform worse than stocks would be in an environment where it's particularly unfavorable for real estate specifically compared to other types of risk assets. So certainly in the early days of kind of the financial market risk, when there was concern about sort of real estate valuations and kind of the bubble in real estate, there were many REITs that were under pressure, but there were still pockets of value. Now, there's kind of a rotation going on, because even though commercial real estate was hurt quite badly, there was a lot of interest in sort of REITs that focused on kind of apartment rentals and that type of thing, because you had this big demographic shift of people who were moving out of homes and into rental properties. So that gave a kind of support to that market. So really, the particularities of individual sectors, really depend on kind of what's going on in the economy, what's going on in underlying stock sectors as well. And it does, it's really variable, and frankly, it's hard to predict.
Yeah, but that's the advantage of going with a diversified, like a Vanguard or whatever, because they would diversify over different classes like strip malls or hospitality, building hotels, or rental properties. So they would take that into account and probably do they strive for like a percentage, like they think like we're going to try to get like 8 to 10%. That's a good return on growth. Like a Vanguard fund, would they do that, or they just say, we're just going to diversify and let the chips kind of fall where they will?
Yeah, that's a good question. I mean, generally they're going to be targeting the most attractive investments within the sector that the fund's allocated to. So if it's a fund that is limited in its investment profile to be focused on REITs, then the managers are going to be kind of trying to balance, on the one hand, diversifying the risk, and on the other hand, trying to maximize the return, given that level of risk. On the other hand, if it's a fund that maybe has a broader brief to invest in income producing strategies, then maybe a portion of the portfolio is REITs, a portion of it might be bonds, high yield bonds or something like that, and then a portion of it might be other types of securities. So it really depends on the individual fund. But with the fund that invests in REITs exclusively, you definitely will get sort of overweighting of sectors and kind of targeting of the areas that that the manager feels are most kind of pregnant with opportunity, let's just say.
I like that. Pregnant with opportunity. That's a nice way of putting it. Of course, when the water breaks, then you had the problem, right? So,
yeah.
So what I'm hearing, if I can distill this down, it's a good investment because it's you can diversify if you use the right fund, right, and that can reduce risk. Or if you wanted to go with a company that was selling REITs directly, I guess you could do that as well, but that would increase your risk because you would have to do all the research on that sector and the performance. And the major ETFs and mutual funds all kind of have exclusive REITs that they deal with, or a mixture with bonds as well. Is that a fair statement?
Yeah, I mean, certainly a large number, and if you have, I guess the idea of REITs fitting in a portfolio is kind of predicated on the idea that you have a diversified portfolio already, and a typical portfolio might be something like 60% equities, 40% bonds, or something like that. And in that type of portfolio, there's quite a lot of academic evidence that would show that diversifying strategies such as REITs will tend to help overall portfolio return and reduce risk over time. So part of it is because of the value of the asset class specifically, and part of it is just from the diversification effect of getting additional asset classes in that don't add to the risk on a portfolio level, but give you the opportunity for slightly higher returns.
So if you had $10,000 to invest in, would you invest $10,000 in REITs, or would you invest $10,000 in bonds?
Yeah, that's a good question. I mean, of course, we would always recommend that you diversify with whatever investment you have. So if you have $10,000 and that's all, then we would probably say the first thing to do is kind of make sure that you have a cash reserve to cover any emergencies that you might have, and then with the balance, then invest on a diversified basis between stocks, bonds, and other asset classes like REITs. And $10,000 in an investment portfolio isn't probably going to go that far, so you might want to just limit yourself to stocks and bonds. But for investors who start to accumulate larger balances through their 401ks or IRAs or their taxable savings, whatever, then it definitely makes sense to kind of look at expanding out the number of asset classes that are included in that portfolio. And for some people it's buying an investment property, and for other people who want to stick to more liquid investments that they can move around or access the capital if they need to, then something like REITs can make a lot of sense for them.
Okay, I'm going to ask, does anyone have I'm typing into the chat saying, does anyone have any more questions for Jim? And Jim, just basically finish the sentence.
I kind of hate to say it, but every time I think of a good question, Jim has pre-answered it before I come up with it. So, and I was thinking of something, and he just kind of answered it again. So I will just sit in the background and listen.
Sorry about that.
That's okay. It's like you're reading my mind.
Well, I'm interested in REITs because I think it's just for a steady income. If you're on a fixed income and you need like dividend income or bond income or whatever to live off of, not as an investment, REIT seems to be if you can get 8%, I think anybody would walk away quite happy with that in today's market. And if it's producing 10 to 15%, and perhaps you can jump out like a regular stock, that might be a good way of jumping in and getting out when it's appropriate. So
Yeah, honestly, I think that in today's environment, I think 8%. I mean, certainly, 13, 14% is not going to be something that you're going to get on a regular basis, and even 8% is probably a bit optimistic. And in today's environment, we're saying a reasonable expectation to have is something closer to kind of 6%, which reflects kind of a risk premium over traditional fixed income over bonds, and but is not. I mean, it's obviously not. It's not like double-digit returns. But given how low interest rates are, it still could be quite attractive. And the main thing that is nice too about real estate that you don't kind of get factored in when you're kind of earning your usual income stream is that if we do get into an environment where there's inflation or where there's a depreciation of the dollar or some of the kind of the disaster scenarios that people talk about and people worry about, then real estate is a great hedge for that. Because there's really no better hedge, in my opinion, for inflation than real estate, because it in every market and in every sort of historical situation that I'm aware of, it's done a very good job of kind of preserving real value.
And also, there's probably a lot of bent up demand. That's waiting to money waiting to flow into it at one point because everyone pulled back their reins on expanding and doing construction and things like that. So it might be a good opportunity for companies to start busting out the banks and start building more. But REITs are really a way of for a company to generate a large amount of investors without using banks. Is that right?
Well, it's a way of generating investment in the form of equity capital as opposed to debt. So if you think about it from the standpoint of a sponsor of a REIT, why would somebody who kind of gets involved in real estate management want to create a REIT or to issue a REIT? It's really because they view their expertise as identifying underlying properties and then managing them and trying to maximize the income. So this gives them a mechanism where they can do that, taking in equity as opposed to, working out with debt, because so many people got upside down, on the commercial side as well as on the residential side, during the most recent real estate bust, obviously, but in the past as well. If you get a situation where, where values drop, and you have bank debt that's outstanding, then obviously that's a position that you don't want to find yourself in if you're a real estate manager. And by having it as a REIT, then investors who kind of are more equity investors are more accustomed and willing to tolerate temporary declines in the value of their assets if it improves the yields and if there's an opportunity to recover over time.
Okay, I thought, I don't know why I thought REITs were more like well, I understand how they work, but I thought the premise behind it was it's kind of like venture capital, where they say, okay, we're trying to raise a $4 million or $10 million fund, and then we're going to build this property, and then after the property is built, that capital investment is going to get distributed back, and you come in at different stages of that build process. Is that right or wrong? Is that how they work?
Well, I think there probably are kind of securities that are more like that, but most of the ones that I'm describing or the ones that we tend to focus on from a valuation standpoint are really more kind of already income producing. So there's less of a speculative nature from the standpoint of trying to understand what a property might produce in income. In a lot of cases, you already have existing rents that are there. You have the properties may have been, built over a period of time, so you have somewhat good idea about what the vacancy rates are likely to be. And it's really, there's kind of more of an assessment of the cash flows and the cash flow growth rates. And certainly in the mutual funds and the ETFs that invest in REITs, that kind of predominates. I mean, there are REITs, for instance, that invest only in mortgages, and there are REITs that only invest in certain types of sectors like healthcare properties and things like that. But if you look at kind of the overall market capitalization of the of the sector, then you're really talking more about kind of cash flow investing.
Okay. I think I had it backwards. I think I had it as it was like a consortium of people or a company going out and buying up, properties or buying up investments, and then taking that money and returning it back to their investors, but then taking a pool of money and then looking at new investment property, new investment buildings. So they're constantly kind of building up their property base while still returning back. So I didn't have it right. Well, I'm sure there are some like that, but
yeah, I think there's a wide range. So I mean, there's probably at least one that is exactly the way you described it.
Okay. Well, I think I'm actually boring everybody. So does anyone have any more questions about real estate investment trusts, or any questions to Jim at all about investment properties or investment in terms of trading or anything?
I'm not really up on REITs at all. I'm just wondering how old are REITs? I mean, how long have these things been done, both publicly and privately?
Boy, that's a good question. I don't know exactly how long, but it's tens of years rather than individual years. I mean, it's really. I mean, I want to say like maybe the 70s. There may be data going back that far. What's happened certainly in the last 10 or 15 years is that the market has become much more developed, and because of the idea of asset allocation has become much more widely accepted amongst individual investors, planners and institutional investors. There's much more demand for these products, and so you get, whenever that happens, you get more segmentation of the different areas and specialization, and so the market becomes much more developed and much more liquid, and that's kind of the situation we have right now is that the expense ratios have come down a lot, the diversification has gone up a lot, and your ability to specialize has increased dramatically as well. And I think all of that is good for investors ultimately because it brings down costs.
Yeah, that makes sense. All right, well, we're going to wrap up the show here. So, Jim, thank you so much, George and Duke, for joining us, and we'll see you again on next week's View on the Market. We're not too sure what the topic will be. We'll figure that out.